All right, we are on chapter 7 of intermediate accounting. And in this chapter, we're going to talk about cash and receivables. All right, so the first part of this is cash and cash equivalent and what is designated as a cash or cash equivalent. So, what is cash? It's amounts that are easily, readily available. If you think about what you've got in your checking account, that would be cash for a business. Okay. It could be currencies, coins, balances in checking accounts, deposits, and money orders. If you are working somewhere that has a cash register, they probably have that set up similar to like a petty cash account, but it would be, it wouldn't be called petty cash. It would just be called like cash on hand to make change or something like that. But that's also cash, even because it really is cash in your drawer. Okay. If you think about all the cash drawers that are at Walmart, Target, or Kroger, there's a lot of cash. There could be a lot of cash tied up just in those cash register. Okay. What are cash equivalents? They have a maturity date of no longer than 3 months from the date of purchase. So that would be money market funds, treasury bills, or commercial paper. Okay. There has to be a disclosure on cash and where it's all at. Okay, so here is an example, note one, summary of major accounting policies in part cash and cash equivalents. So they go on to tell us cash and cash equivalents include cash on hand, highly liquid investments within 90 days, and or 3 months. I just said 90 days, same thing, 3 months. Credit, debit card receivables, which will generally be settled within 1 to 7 business days. Um, and then they just kind of tell us the amounts and where it's at. Okay. Because credit cards, that would be a receivable, but when a charge is made on that credit card, the cash comes to the business really fast. They said 1 to 7 business days. It's usually like 3 to 4. You get the money from Visa, MasterCard, Discover, and all of those. Okay. So that's how we have to disclose it. With cash comes a lot more internal control because cash can walk away a lot easier than, say, I always use the example, the big table in the conference room. If we wanted to take that to our car, somebody would see us. Somebody would see us trying to take that out, and we probably would not be able to get away with it. Whereas cash can be put on your person, it can be hidden anywhere on you, and then, you could take that out of the building. It's a lot easier. So just because of the what it is, it makes the risk of losing cash a lot higher, just because they call that an inherent risk. Okay, so what does good internal control do? Okay, good internal control, first thing, is going to encourage adherence to company policies and procedures. Okay, those policies and procedures that businesses have are there for a reason. Okay, there is a reason for that. Um, Probably one of the most common one is gifts that you can accept. Um, where my husband works at, it used to be like something really low at his old job, like $25, but I guess inflation and things like that, then it's now $100. So I had a little experience with that just here lately. Somebody that my husband doesn't not it's not somebody that works at Frito-Lay, but somebody outside of Frito-Lay gave him a very expensive gift. He did disclose it and figured out how much he does have to pay for some of the gift because their policy is $100 or less. Okay. So it really put him in an awkward position because, didn't really know what to do with it. This expensive gift just shows up delivered to our house. When I say expensive, it's less than $1,000. I'm not talking about tens of thousands of dollars. Okay. But part of it, he will have to pay. Okay. But there's a reason why they have that, okay? Because if he could just accept any gifts, his decision based on maybe who to award a $1 million contract to might be swayed. He might be encouraged to go one path when it's not the best path for the company. So that's why they have these policies and procedures, and he's not in that position. Very honest and ethical. I always worry about things like that. Are they testing you just to see how honest and ethical you really are? Okay. All right. The next thing is to promote operational efficiency. Okay. When the operations are running efficient, money is usually being made, and that's a good thing. Okay. You want to minimize errors and theft. Okay. And enhance the reliability and accuracy of the accounting data. If you can rely on the data and it's accurate, you can make better decisions. Okay. So the reliability and accuracy will help you rely on the data to make better decisions. And usually that turns into more profitability for the business. Okay. So a little bit more about internal control. Sarbanes-Oxley. This came about, it's old nowadays. It came about in 2002, but it is still it's the most recent thing. If you think about how people felt, what, 23 years after the Great Depression, people still remembered it. Okay. People still remember it. You probably have grandparents or great grandparents that remember the Great Depression and they will tell you things about it. Well, I lived through this. It wasn't a Great Depression, but it was a time of a lot of accounting fraud that was being uncovered. Okay. So now with Sarbanes-Oxley, they are required when they do an audit of the financial statements, they also have to audit the internal control of a business and find out does this business have a good internal control? Because remember, if we have good internal control, we have lots of great things up here going on. Okay. So it's sort of almost like a dual audit now because there is an opinion on the financial statements and there's an opinion on the internal control. And I know this is an auditing class, but this sort of bridges over into audit. And several of y'all will be taking audit within the next year, year and a half at least. Okay. Who comes up with these systems of internal control? Where one organization, I don't know if there's any other organizations, this is the only one I've ever heard of, is the Committee on Sponsoring Organizations, COSO. And they are the ones that come up with standards and they create this. So a lot of times that COSO is mentioned in the report. They follow this company adheres to the rules of COSO or Committee on Sponsoring Organizations. Okay, so they define internal control. What is good internal control? What is not good internal control? They look at the effectiveness and efficiency of operations, the reliability of financial reporting, and then compliance with applicable laws and regulations. Now, when we're talking about here, we're not just talking about accounting laws and regulations. We're talking about any laws and regulation. Because if a company is dumping toxic waste in the Arkansas River, that's something us as the auditor we need to know because if they get caught doing that, it's going to hit their bottom line because they're going to be fined. They're going to be fined a lot. They could be, they might go bankrupt for that reason. And those are things we as the auditor need to know. Are you following laws and regulation of your industry? Okay. So moving on. It is always a good thing to have a good system of internal control to have separation of duties. Okay, I've drawn this out before. I learned this when I was taking the CPA exam several years ago, and it's really good. I don't think they have this in the book, but this really helps. We have this ARC, ARC. Okay, A stands for authorization, not accounting. Oops, sorry about that. R stands for recording. And C stands for custody. Okay. So I use this example because it was a very good example, but please let me disclaim that I never stole any cash from the hotel that I worked at. Okay. When I was 19, I went to work for a hotel and as part of my job duties, I had a cash drawer and I was underneath this function right here. I had custody of that asset. Any cash that gets turned in that day, I had to account for it. Okay. And so A couple of years went by. I worked there for a long time. And then as I went back to college and was about to get an accounting degree, they needed a bookkeeper. And so I moved out of the front desk clerk option or role and I moved over into recording because I was the bookkeeper then. Okay. I really should have never gone back and handled any kind of cash because then there's not a separation of duties here. Okay. So I'm not supposed to go back there. Did I go back and work on the front desk? I did. I'd worked there since I was 19. They knew I was an honest and ethical person. So even though the good system into internal control says I'm not supposed to do that, we were also very small. And in a very small business, it is hard to get a good system of internal control. Okay when we've talked about internal control before, one of the most important things is to hire honest and ethical people because if you're not a very big business, you've got to trust them, okay? And you know, make sure like that's being checked quite frequently. Because the reason being, I could have stole some money on the front desk, which I did not. And then I could have gone back to the back office and made a journal entry to cover it up. So you can kind of see where those duties should not be mixed with each other. Okay. If you have authorization, then you should not have access to recording because you can authorize yourself a brand new laptop and make a journal entry for it. Okay. So this is called the ARC. It helps you figure out the separation of duties rather than just go through all of these things that they have right here. I really like this. It's a good visual. I had friends who pastored a church a long time ago, and I did this right here. I pulled this arc out and I showed them this is how we need to do it. And in that case, I really did I stayed separate. I was recording, I was the secretary, pastor was the authorization. Somebody else took the cash to the bank. We had we had the ushers who took like the money up in the offering plate and they would total up the cash, add it up. Then somebody else would take that to the bank and then I would get the deposit slip and what information was recorded and I'm going to make sure that lines up. And the reason I did that was because I didn't want to show up to church with a new car one day, not because it was a fun thing. I probably bought a car because I had to have a car. But I don't want to show up for church having bought a new car and somebody be like, oh, that's Sister Heather. Like, she's been doing our church books. I wonder if she's stealing money. I wanted there to be no doubt in anybody's mind that I didn't even have access. There wasn't even a possibility for me to steal the money and then make a journal entry to steal it. Okay. So internal control not only helps you, it helps the organization, but it helps you too, because you can say, hey, I don't even have access to that. So there's no way I could do that if you have a good system of internal control. Okay. All right. So internal control procedures for cash disbursements, we want them to be usually done with a check. Okay. Our objective is to prevent unauthorized payments and to ensure disbursements are recorded properly. Okay. All disbursements should be made by check, not cash. Okay. All expenditures should be authorized, and checks should be signed only by an authorized individual. Sometimes checks have a signature automatically printed on them. It just depends. There's so much electronic funds transfers these days. We still do use checks in the business world, but there's so many of these electronic funds transfers, which is actually really good because it cuts down on like a check getting lost or the check getting stolen. And yes, you could steal a check. It has happened before. You can steal a check with that it's made out to somebody else, and you can take it to the bank and cash it because you may know the clerk that's in on the fraud with you. So it has happened. It can be done. So don't think just because you sent a check to somebody and you addressed it to somewhere that that's whose hands it's going to be in. So the electronic funds transfer sort of helps that a little bit more, but there still could be fraud in electronic funds transfer. Okay. And another control they might have is like, what if this is a high, like, let's just say checks are usually under $5,000, but if they're more than $5,000, we want two signatures on there. So that's a really good internal control. So then, we're kind of looking at, okay, anything over 5,000, that's a really material number. We might want to check two signatures on that check just to make sure that it is correct. Okay. All right. We're going to skip the little concept check. And then we're going to come down to restricted cash. Sometimes cash can be restricted for whatever reason or another. The bank, it may be a loan covenant. The bank may have said, hey, you need to make sure I'm going to loan you. We're going to come to an example in a minute. I'm going to loan you $10 million, but you need to keep $2 million in a cash account. Okay. That is a loan covenant. And if we break that loan covenant, then they're going to call the loan and make all of it due because you broke the loan covenant. Okay. It could be for a specific purpose. It doesn't necessarily have to be you just borrowed money. It could be for future plant expansion, things like that, which is perfectly fine. Okay. The one thing to realize that we got to figure out if it's current or long term. So I'm going to write my accounting equation out again. Remember, we have our current assets, current liabilities, long-term assets, and long-term liabilities. Okay. So the debt instruments, if they require the borrower to set aside funds, if the debt is non-current, then restricted cash, then it will be non-current. So it'll be down here, more than 1 year. Okay. If it is current, then it will be up here. So that's kind of basically what they're saying right there. So you just got to be mindful because or making sure those are categorized correctly is a huge thing. If we find that they're trying to take long-term assets and put them up here in the current assets, that's a big issue. Okay, because remember that current ratio? Current ratio is the current assets divided by the current liabilities. We want that number to be higher, but there's one of two ways we could do that. Okay. We could be looking at moving some long-term assets up into current assets. So you really never have to worry about them taking current assets and moving them down into long-term assets because that doesn't help them. Okay. They're only going to be looking one way at that. Okay. We're only going to be looking on liabilities that they're trying to take some current liabilities and move them down to long-term liabilities because doing either one of those makes that current ratio go higher, which goes a lot into all of the pricing and everything for this business. So they're probably never going to try to take long-term liabilities and move them into current because that doesn't help them. So in audit, you'll kind of figure out sometimes there's only one way we audit because they're never going to go the other way ever. Okay, because that's not going to help their ratio. So you sometimes want to look at it in the direction they are trying to perpetrate the fraud. Okay. We could have some compensating balances. This is an amount that compensates the bank for granting a loan or extending the line of credit. So the next slide actually gives us an example here. Okay, so let's do this one really quick. I did a little bit of calculation. Even though it was here on the slide, I did a little bit off to the side, so kind of help. So it says a company borrows $10 million from the bank at 12% interest. The bank requires a compensating balance of 2 million to be held in a non-interest bearing checking account. Okay. So we're really only netting a loan of 8 million, but they're going to charge us interest on 10 million. Okay. So for the year, if we multiply that 12% times the 10 million, we will have interest of 1,200,000. And now we really did not get $10 million, even though we're paying interest on $10 million. We only got, because we've got to keep 2 million in the account. And so we're going to subtract the 2 million out of there to get 8 million. Okay. So that's really what our loan is. Okay. But they're charging us 12% interest on 10 million. So if we take the 1.2 million, the interest, and divide it by 8 million, which is the true amount of the loan, then you end up getting 15% interest. Okay. Not really 12. Okay. Because of that compensating balance, you have got to keep 2 million in an account. So they may have wrote you a check for 10 million, but you've got to turn around and put 2 million in a checking account and you've got to keep it there the entire time of this loan. Okay. All right. We are moving right along here. So, kind of just quick look at how International Financial Reporting Standards is on cash and cash equivalents. So, we're in US GAAP. We're really not learning IFRS. International Accounting will be in the spring of 26 and then not again till spring of 28. It's once every 2 years. I try to get my accounting majors to take it because it's another upper level accounting class that will count for you taking the CPA exam. So, just a quick little review on that. US GAAP overdrafts are treated as a liability, whereas for IFRS, it allows the overdrafts to be offset against other cash accounts. Okay. For US GAAP, it requires assets and liabilities to be stated separately on the balance sheet. Liabilities can offset against other cash accounts and stated at their net value on the balance sheet. Okay, so they can do that. I try to keep an open mind when it comes to IFRS because it's really easy. I've been doing GAAP accounting forever. When I first started teaching international accounting, I tried really hard to take a step back and say, hey, you know what? IFRS may have something better. I didn't want to just be closed-minded to, you know what? It's GAAP all the way. It's US GAAP. Okay. Because a lot of US companies use IFRS. Okay. US companies have the choice. They could use GAAP or they can use IFRS. Okay. All right. So moving right along, current receivables. Those represent a claim to future collections, usually within a short time period. Okay. You're not going to find them extending credit for like accounts receivables out to over a year because they're going to want to charge interest on that. Okay. So accounts receivable does not accrue any interest. You could have some non-trade receivables. They call all those ones that you're dealing with customers, they call those a trade receivable. Everything else could be kind of classified into some of these as non-trade. A tax refund claim. You filed your tax return, you know you're getting a refund because that you had to make that entry to pay the taxes, but you're going to get a refund. So that's coming back to you. You could have an interest receivable or advances from employees. I did not really think this was a thing, but it really is a thing. I've never had enough nerve to ask my employer to give me an advance on my pay, just because that sounds really embarrassing for number one. But I'm not that bold either. I'm just going to make do. I have a credit card. I can put something on my credit card and I can pay it off when I get paid. Okay. If I'm in a tight spot like that. Okay. Could be a notes receivable for registered trade or non-trade. It just has this formal promissory note and some sort of interest. Okay. All right, accounts receivables, trade receivables. These usually arise when we are earning revenue. So remember, our last chapter went over earning revenue. You kind of have to think about that just a little bit here, okay? The performance obligation is satisfied and satisfied at the point of delivery, so we've earned the revenue. A lot of students get hung up. They don't think they need to record revenue because they didn't get the cash, but we don't care in accrual-based accounting. We have that is an asset to us. We know that is coming. If we don't make a journal entry for it, it's going to be really hard for us to track who owes us, number one. Okay. So we do make a journal entry for it, record that receivable, and then we'll track it that way. Okay. Revenue related to the receivable is recognized at that time. Most businesses provide credit to customers. Now, I always say this, that's usually not customer to business, it's usually business to business, like Walmart to Frito-Lay, PepsiCo, okay? That kind of credit. You'll find that a lot more common. But if me and you go to Walmart and say, hey, we're going to get this buggy load of groceries, we'll come back next Friday and pay you. they're going to put us in jail. Okay. They're going to pretend like we are stealing the groceries and the police will be called. So we can't do that. So when they say customers, they're probably talking about another business. Okay. It's usually only 30 to 60 days. I have seen it go up to 90 days. Those are usually very expensive items like a big Caterpillar tractor or something like that. Okay. Classified as current assets because their collection period is part of the operating cycle and they plan on collecting it. Yes, they may not collect it because it could be bad debt, but they plan on collecting that within the period. So it is current. Okay. So, initial valuation of accounts receivable. Remember how we recognize revenue. All right. The sellers recognize an amount of revenue equal to the amount they are entitled to receive in exchange for satisfying a performance obligations. Okay. Sellers can allocate the transaction price to various performance obligations. There can be more than one. The previous chapter we saw where it had 2 and 3 performance obligations. Okay. Some of the complexities that come with this is that time value of money. We talked about that in chapter 5. If this is going to be over a significantly long period of time, we're going to have to take that into consideration, the time value of money. And variable consideration. Remember variable consideration? That's where I think they went through a problem where, hey, we're going to give you 180,000, but if we can get our views up to a certain amount, we're going to add a bonus. I believe that bonus was like what, $180,000 or something. So that's a variable consideration, which can make it a lot more complicated. Okay. When you have these trade receivables, you will get a trade discount. Um, it's usually a percentage reduction of the list price. So let's just say they may think, okay, if you order $3 million of product from us this year, we're going to cut you a break and we're going to give you a percent off of that. That's a quantity. Okay. The sales discount is different in that if it gets paid in the discount period, we're going to give you a sales discount. These two are separate from each other. They are not the same thing. Okay. So down here, the sales discounts, they have these terms 2, 10, and 30. Okay. There is a 2% discount if it is paid within 10 days. It's always read the same way. Even if it's a purchase discount, it's read the exact same way. Okay. Then the net is due. Let me put net. N stands for net, is due within 30 days. Okay. So if we pay it in 10 days, we get a 2% discount. If we don't pay it in 10 days, we have 30 days to pay for it. Okay. So just a little quick, let's do another one. 315 NEOM. So this would mean 3% discount if it's paid within 15 days. If it's not paid in 15 days, the net is end of month. That's what EOM stands for, end of month. Okay. Just to give you a couple of variations, but they're always read the exact same way. All right. When we have receivables, and especially when we're selling a product, like not just a service, we're selling a product, and we have these credit terms, this can get a little bit complicated. Okay. There's 2 different ways we could do this. Okay. So let's read through this one. Hawthorne Manufacturing Company offers credit customers a 2% sales discount if the sales price is paid within 10 days. I believe that was the previous one. 2%, 210. Any amounts not paid within the 10 days are due in 30 days. Okay, so the payment terms are stated. This is October the 5th. Hawthorne sold merchandise at a price of $20,000. I believe when you were in Principles of Accounting, we did the gross method. Now that you're an accounting major and you're in intermediate, you have to know how to do the gross method and the net method. Okay, so the gross method we're going to assume, we're not really assuming anything because we hope that we have the money to pay this and give a discount or they pay us. Okay. So it's just two different ways to keep up with it. And they are both tested on CPA exam. Okay. So gross method, we're going to leave that 2% in there. Okay. I prefer this way, just preferably, mainly because it's what we do in principles and I like it. I'm not really a big fan of the net, but it's okay. You still have to know how to do both. So for net method, we're going to assume they're going to take the 2% discount. So we take the 20,000, multiply it times 2%, and you should get 400. I do this kind of math sometimes right there. They took 20,000 and then just multiplied it times 98%. All that is 100% minus the 2% to give you the 98%. I just sometimes do that because it's just an easy keystroke on my calculator. Okay. Especially if I didn't really need to know what that discount is right now. I'm just recording it at this amount. Okay. So here's gross method and net method. We're going to continue with this. It says everything I think is the same right here, except right here. We are going to add these two lines. Okay. Said the customer paid 13,720, 14,000 minus the 2% sales discount on October the 14th, and the remaining balance of 6,000 on November the 4th. Okay. So the gross method, we did not assume that they were taking that discount. Okay. We are going to debit cash because they're sending us 13,720, but we still have to take 14,000 out of our accounts receivable. So I'm going to do the T account under the gross method right here. Okay. So we debited accounts receivable for 20,000, and then they paid us 14,000 of it, or 14,000 minus the 2%. So we will credit the 14,000 here to give us 6,000 in the accounts receivable. Why don't we just go do the gross method really quick on the other 6,000? So November 4th, they come down and they pay us the other 6,000. We debit cash and we credit accounts receivable for the 6,000. So you can see now my receivable under gross has gone down to 0. Okay. So now let's do the accounts receivable with the net method. Okay. We debited accounts receivable for 19,600. We went ahead and took the 2% out. Okay. Then we're going to credit 13,720. I did not do that out enough to know what that is. Let me get my calculator. And 19,600 minus 13,720. Okay. We end up with 5880. Okay. So we come down here. You see we have the 58,880. They're taking that out and making that 0. Okay. But they sent us a $6,000 check. Okay. We have a credit of $120, and that is called sales discounts forfeited. This is a revenue account because when we made this journal entry way back up here for the 20,000, we did not record $400 of revenue. Okay. We only recorded 19,600. Okay. So the 120, you could calculate it. You could take the 6,000, I believe, multiplied times 2% would give us that 120, and they forfeited that much. Okay. But if you draw the T account out, you see how much you've got to take out of accounts receivable. So I like the T accounts because that does help you. Okay. All right. So notice that net sales didn't change for gross method or net method. It's just what was reported in the meantime while we were waiting on that money to be collected. Okay. We recorded sales revenue of 20,000. We took out 280, so we ended up with 19,720. We only recorded 19,600 and we add the 120, we got the exact same amount. So after the collection date, it's really okay. It doesn't really matter which one you're using. But if you had to have, if this entry crossed a year in, then some things could be messed up. It could make, not really messed up, it could just make things a little different in how they're read. But it would have to be disclosed as to what are they, what is their policy? Are they using the gross method? Are they using the net method? Okay, we'll jump past that. They ask which is correct. Okay. Sales revenue and corresponding accounts receivable should be stated at the amount of the consideration the seller expects to be entitled to receive. Net method does reflect that amount. Probably the net method might be the most conservative. Okay, because you're not over inflating sales or your accounts receivable, so it might be more of a conservative. And when I say conservative, again, I'm not talking about political affiliations. The conservatism principle just says we state assets at the lowest amount and liabilities at the highest amount. We want net income to look worst case scenario. Okay. So you can kind of see, they go through this problem. You can kind of see if you missed out on a discount, what that would translate into an effective rate. Okay. So just a 2% discount being paid a little bit early is really quite a bit. It doesn't sound like 1 or 2% is that much, but it could make a very big difference. Okay. All right. We will pick up in the next video on sales returns.